Welcome to the Holistic Wealth and Health Podcast. Your co-hosts, Jason Smith and Bryan Bibbo, will inspire and teach you how to prosper in your mind, body, and spirit, not just your financial life. Joining forces with field experts, Jason and Bryan are here to help you focus on what matters most in your life, living well.
Hello, everybody. Bryan Bibbo here with J.L. Smith, Holistic Health and Wealth Podcast. We're here for another episode. I got an exciting guest here, Jeff Warnkin, friend, colleague. He's a CFP, a CPA, an NSA, and also bucket plan certified. He is a senior wealth manager at J.L. Smith with more than 25 years of experience in the financial services industry. He specializes in estate, financial, and retirement income planning, helping clients create strategies that maximize what they keep after taxes. Jeff's deep expertise and multiple professional designations uniquely position him to guide families through life's most important financial decisions. Jeff, always wonderful to have you on the podcast.
Thanks, Bryan. Happy to be here.
Yeah. So I know that the topic which you are very versed in as a CPA, and you have that master's in taxation, we're going to talk about the benefits of the three-pronged tax approach. When we're talking about that, we're talking more of the tax management, planning, and prep. So let's start with kind of that myth that's a little bit out there is many people equate like tax planning and management with like simpler filing. Why is it important to distinguish between just that preparation, planning, and then also management? Why is it could be a risk if we just blur things all into one and you just do that tax preparation each year?
Yeah, great question, Bryan. And I love the lead in because if I've learned anything in my 3 decades plus career, it's the biggest difference between what you make and what you get to spend is income taxes. So understanding how all of this works and doing this proper tax planning and coordinating it with tax management and then ultimately tax preparation is extremely important. And I noticed early on in my career that there was a big disconnect between tax preparation and what the advice that people thought they were getting and then what actually got done. And so your question is spot on. And I would answer it by asking a question. If you were going to build your dream house, you wouldn't just go out and start throwing up walls and floors and roof trusses and things like that. If you were going to build your dream house, the first thing you would do is you'd go out and hire an architect. And you would work with the architect to put together the best plan possible. So that's the equivalent of tax planning, having that blueprint for what you want to see come to fruition in your dreams. Then secondly, you would go out and you would hire the builder. So that's the equivalent of tax management, the real world application of that plan and bringing this thing together. And then after it's all done, the inspectors would come out and make sure that everything went according to plan. They document everything, cross all the T's, dot all the I's. That's like tax preparation. So if you don't get these in the right order, or if the lines and distinctions get blurred, it can cause you to make some costly mistakes or step in some tax landmines, as we like to call them, and end up paying more than you need to.
Yeah. Don't blur the lines, right? Understand There's a huge difference, but you used kind of a great metaphor when you were talking about tax planning, and it's the role of the architect, right? You said, hey, if you're going to build a house, we need that architect to kind of do the blueprint. And that's really what tax planning is from what you're saying here. So when you're pointing to kind of that strategy or you're building out that blueprint, there's these moments of transition in life, like retirement, maybe turning 50 and there's other options too, 59 and a half, selling a business, or even some estate things like gifting strategies. But how does planning at those crossroads actually change the financial outcome over decades? I know that planning can be done a lot of those times. Those are an event that happens in 1 year, but getting it right, how does it affect it for many years to come?
Proper tax planning begins with understanding that not all money is taxed the same. Those 7 little words are so important because we don't make the distinction all the time between the different ways that your money could be taxed, whether it's ordinary income or capital gains and things of that nature. And proper tax planning helps avoid the avoidable taxes. So taxes are optional, but certain taxes can be avoided. And where the rubber really meets the road is when you do that proper tax planning, and then later on, the transaction comes to fruition and you've helped a client avoid a large capital gain that they might have to pay tax on. You've helped them avoid blowing up their income and blowing up their Medicare premiums. You've helped them from paying excess income taxes on their Social Security benefits, or avoided a penalty because you didn't calculate your required distribution properly, or you paid net investment income tax when you otherwise might not have had to do that. Those are the avoidable taxes that, with that proper planning, you can achieve a much better result.
Yeah, I like that. You talked about something that Medicare. What does Medicare have to do with taxes? I heard that in there, but what the audience needs to know is how is this related to taxes?
Sure. And to be sure, the Medicare premiums that are means tested, meaning that they'll look at your income on a 2-year lag. So, for example, we're in 2025 right now. And if you're on Medicare, your premiums that you're paying for your Medicare Part B and Part D prescription drug plan are based on your 2023 filings and what your adjusted gross income or modified adjusted gross income was in 2023. And if it's above certain levels, which a lot of the folks that we work with, I mean, it's a good problem to have, but a lot of the people we work with are at or above those levels, and it can cause their Medicare premiums to go up significantly. So it's not a tax per se that's levied through the tax return, but it's one of those hidden traps where your overall cost can go up because something appeared in your modified adjusted gross income that maybe could have been avoided or managed differently. And then those Medicare premiums wouldn't have been affected. They're only affected 1 year at a time, but it can still add up to a significant amount of money.
Yeah, that's crucial. So the income thresholds that you had from 2 years ago are going to affect your Medicare premiums. And I also know is like if you file a separate tax return and you're over a certain level, you can skip a bunch of brackets when it comes to Medicare. So it's crucial to say is like when we think of the 5 pillars of holistic wealth management, right? One of the things we think of is protection planning, which comes down to partially healthcare, right? Making sure you have the right healthcare in place. But if you're not taking the protection planning and then the tax management that we're talking about here today, and then the asset management of like income coming in and marrying these things together, you could run into some, like you said, some bigger traps of things. So how does ongoing tax management help not just execute a plan, but continually adapt it as tax law, income levels, or life circumstances shift?
Sure. Well, tax management, I look at, as I said before, is the real world application of your tax plan. It's really the difference between, theory and then what's actually happening out there in the environment. And as we all know, the real world loves to continually throw us curveballs. So we need to be constantly vigilant to tax law changes as well as life changes and changes in our family structure and things like that in order to be able to adapt. A great example is this year we have the big, beautiful bill that was passed, and there's over 1,000 pages of tax law changes and provisions in there that we boiled down to a 49.
Only 1,000, right? Only 1,000.
Only 1,000, right? We boiled it down to a brief little 49-page summary. And there's a lot in there, but for the majority of our retiree clients, I think the most significant thing in there for us as financial advisors and who are responsible for maintaining this tax planning, tax management, tax preparation trilogy is the fact that tax rates and brackets were made permanent. So it's interesting that one of the most important provisions is actually something that we're not going to feel, but that's actually a good thing, because if they hadn't done that, taxes were set to go up significantly at the end of this year, which was not on a lot of people's radar. So now at least we know what we're dealing with. We did not get the full repeal of tax on your Social Security benefits, but we got a new senior deduction up to $6,000 per person if you're over 65 and receiving Social Security. So those are the types of things that you have to continually factor into the situation and be adaptive. And that tax management has to be a dynamic, ongoing process.
Yeah, Jeff, over that 3-decade career that you had shared with us and being involved in taxes, I'm sure you have a story or two to share about, give me an example where proactive tax management significantly improved a client's after-tax wealth compared to someone that just relied on, only that annual tax preparation. What would you say there? Maybe if you have a story or two.
Yeah. Well, over that time period, I've had to relearn the tax code at least 3 times, I would say, looking back at major tax changes and legislation and things of that nature. I would say that I think the most impactful tax planning strategy that we've actually been able to, see through to tax management and see it come through into fruition has to do with accelerating income in this relatively low tax bracket and tax rate environment that we've been in. So that has to do with things like Roth conversion planning, moving money from your taxable IRAs to your forever tax-free Roth IRAs. And it sounds good, and it's a great plan, but actually implementing that and making it happen through the hands-on tax management that we do with our clients, crossing those T's, dotting those I's, and then actually seeing the result of it on the tax return when you do the tax preparation, and making sure that everything's in alignment. There's no gotchas. The clients understand what's coming, and and they're ready to write that check. Because let's face it, income acceleration means having to write that check. So we're not going to ask a client to do that if there's not very good reasons for that. And in this very low tax rate environment, it makes all the sense in the world to fully utilize these low brackets. If you're in the 12% bracket and you're halfway through it, take them up to the top of the 12% bracket. If they're in the 22, let's do some conversions and take them to the top of the 22 or maybe into the 24. Being mindful of all these other landmines that are out there. But I think that one practice strategy that we've employed over the years has made a huge difference, not just for our clients and the taxes that they'll pay and the peace of mind they have knowing that they've taken control of when and how that money is going to be taxed, but also to the beneficiaries that they're going to be inheriting money that is not going to be encumbered by a tax lien has been huge.
Yeah. So a lot of that accelerating income and maxing out the brackets. And one of the things you said before, the tax rates have been now made permanent, right? So it looks like we can continue to do some of these Roth conversions. I mean, we're essentially listening to you and you're sharing with us 3 decades experience. And you're telling us right now, we have the ability to do one of the biggest, if not the best you've seen tax strategies, right?
Oh, absolutely. And keep in mind when I say that the tax rates and brackets have been made permanent, that is in the sphere of tax legislation. There's really no such thing as permanent. They're permanent until they get changed again. But I think we have certainly a longer window of opportunity than we did a few months ago before the bill was passed in order to affect some of these changes and take advantage of these very low rates and brackets.
I mean, it's just amazing here. It's really eye-opening for you to share your experience and say, hey, now is a great time compared to something that was 10, 20, 30 years ago. So we appreciate that candor from you. Now, there's this misconception out there that we run into as financial advisors all the time, and it's people assuming that their CPA or tax preparer is naturally managing the strategies for them, the ones that we're talking about, like protection planning, tax management, preparation, planning, and looking at the investments at the same time. And we know that there's a lot of gaps there. So, what can we say are some of those key gaps that often remain if a client only relies in saying, hey, my CPA is doing X, Y, Z, or my tax preparer is just doing that with the tax service? What were some gaps you've seen over the years? Because I know you've shared stories with me originally that you would give people tax advice when they would come in for you. And then the next year they come to do the tax return, and it's totally something different. Speak about that.
Yeah, exactly. And that's really how the concept of holistic wealth management for me came into being. We didn't call it that back then. We didn't have that terminology, but it really was born out of the frustration of working with clients and doing their taxes and giving them my best advice. They begin to get their tax return done. And I'd say, hey, have you thought about opening up a Roth? Roth IRAs were very new back in 25 years ago. And have you thought about contributing to a Roth, or, you thought about adding to your life insurance if you had your legal documents reviewed, things of that nature. And then I'd write it down and I'd close the file. People would come back the next year to get their taxes done. I open up the file and I go, oh, hey, did you open up that Roth IRA? Did you make a contribution? Did you add contingent beneficiaries to your annuities and life insurance? Did you get your legal documents reviewed by your attorney? And what do you think the answer was 99% of the time?
Oh, I was told to do something else or no, right? I'm sure.
Right. So, the vast majority of the time, people either didn't do it, and it's not because people are bad. It's just life gets in the way. By the time they hit my parking lot, it was already out of their mind. So most of the time, people either didn't get it done, or worse, in some cases, is they did go to they went to their advisor and said, hey, my tax guy said I needed to do this. And what they came back with was not only not what I recommended, but it's in some cases not suitable for them at all. And that was a source of great frustration for me. And again, kind of the genesis of how we started down this road. Because let's face it, I'm a CPA, I've been a CPA for a long time. And in general, CPAs just aren't wired for that forward-looking advice. CPAs are a fee for service. They're really good for compliance, making sure that you follow all the rules, meaning that in the tax preparation side of things, the forms are filled out properly and everything's claimed and all of that. And it's going to get through the IRS, and you're going to file it electronically with the IRS, and they're not going to have any problems with it. But making those forward-looking judgment calls really requires you to take into consideration everything that we know right now in the sphere of tax law and investments and retirement plans, plus the consensus opinion of what's coming, and marry those two together and make the best recommendation that you can for a client at any given point in time. And then monitor and adjust down the road if we need to. See that skill set just doesn't always intersect. And again, I say that with love in my heart because I am a CPA, but I've just seen it so many times over the years.
Yeah, the progress always starts with the truth, right? So, yeah, it's good stuff. But if we had to summarize a lot of what we're saying here today, that this true tax management involves oversight, investment alignment, right? And healthcare alignment too, especially with the Medicare concept we talked about, and then also withdrawal strategies. How do these pieces fit together to influence not just yearly taxes, but a client's overall wealth trajectory? I know some of the stuff that we do, and as fiduciaries, when we sit in front of clients, we're able to say to them, hey, if we do these strategies, we're able to quantitatively show them like what these mean in the long run to them. I want you to hear your opinions, your thoughts on that.
Yeah, absolutely. And the start is to understand that we all have a tax plan. Whether we think we do or not, we all have a default tax plan. And who do we think that the default tax plan is written by the U.S. Treasury? And who do we think that's going to benefit? Is it going to benefit us, or is it going to benefit the government? And the only thing the government needs to do to collect on that plan is outlive us, which is a pretty good bet. So you have to understand that we are all born with a default tax plan. If we proactively find a professional and do a tax plan, enter into a tax management agreement, we get to lift ourselves out of that default plan. So each of those areas you mentioned, if we nail each of those pieces, we might have some really great sounding instruments, but if it's properly coordinated, we'll have a symphony. What that means is a client's lifetime tax burden, meaning all the taxes they pay while they're working, the taxes they pay in retirement, and then the taxes that they or their beneficiaries are going to pay when those assets transfer to the next generation. We are going to minimize as much as possible that lifetime tax burden. And that is a very worthwhile goal in my estimation.
I've heard you say this before. You're on third generation clients, right? You've essentially worked with the grandparents, the parents, and now the grandchildren, right?
You're really dating me now, Bryan.
Yeah, you know what? I'm going to tell you, Jeff, it shows how well you've survived in your career and you've done the right things for clients, right? You've stayed in tax and financial planning essentially your whole career. And that speaks a lot of volume to your character. So that's what I would tell you. I mean, obviously, I know you personally. You've been a great teacher and mentor for me personally. But I want to kind of talk about that is when we think about tax planning, even those grandchildren, when should they start thinking about taxes? Is 20 years of age too early? Like, what would you say is the most important thing, depending on whatever age you're at? When should we start thinking about taxes and planning?
A great question. I don't think you're ever too young to start thinking about it. I've had, as you mentioned, I've had the pleasure and honor and privilege of working with second generation, and in some cases, third generation clients. And I think a lot of that has to do with the integrity comes from putting your client's interest first, certainly, but also, using your own situation as a template. I do all the same things that I recommend for my clients. So I can speak from the heart. I've done things for my children. I've set up plans for my children. All my children have bucket plans. They know about them. They understand them. They know what role each bucket is playing. They understand the importance of funding the Roth. And it's really great to actually sit with those second and third generation clients and look at what they're doing and help them understand where they're at and the things that they should be thinking about at that stage of life, because I've been there. I went through all of that. So again, I can speak from the heart, understanding all the decisions that we're facing, because we're facing all the exact same things in my life right now. I've got 3 adult children now. We're empty nesters. And a lot of my clients are in that phase of life as well. But boy, it doesn't seem that long ago that we had 3 little kids at home, and life was very complicated. But it goes by so fast, as Carl Smith says. The days are long, but the years are short.
Yeah, amen, brother. If you had to come up with, let's speak to those children real quick. That all your children are 20 to 40 years of age, huh? And I'm giving it a broader kind of construct. But what would be 1 or 2 tax strategies you would say to those 20 or 40-year-olds?
I think to understand, there's the 3 best tax breaks in the tax code. The 3 best legal tax breaks in the tax code are the step up in cost basis, number 1. So I would have them investing in a growth-oriented mutual fund outside of a 401k or an IRA with some of their disposable income, and just keep building that up, because those funds can pass to the next generation. And under current law, there's a complete step up in cost basis. There's all the gains are forgiven, and it doesn't cost them anything to do that. That's the first. The second is the provisions that allow for the tax-free withdrawals from a Roth. And so getting them started, understanding that they can fund a Roth IRA. They can, in most cases, employers have amended their 401k plans to allow for Roth contributions. So getting them started on that road right away that, look, we want to separate our money from the effective taxes, both federal and state taxes, as quickly as possible and get that going right away so they never fall into this trap of deferring their taxes into retirement. So the ability to fund a Roth and take those distributions out tax-free, that's the second best part of the Internal Revenue Code. The third is the tax-free death benefit and tax-free buildup of cash value in a properly structured life insurance program. I can't emphasize enough how important that is, even for the young people. That's when they should be starting. Even if it's just a small part of their disposable income, they should have a personal, private, permanent life insurance program that they start, and that way they can guarantee their insurability while they're young and healthy, and they can start building up those values. And those provisions in the tax code are very, very powerful. Those are my three favorite sections of the Internal Revenue Code. And if I can get a client to cover all three of those, especially at a young age, then boy, we're hitting on all cylinders.
That's amazing. I mean, we've talked about the 40-plus-year-olds also, and one of the things there was just taking advantage of the current tax rates. What could you be doing now to save for the future? Also, we talked about maximizing certain brackets and then converting some money to the Roth, but there's a lot of things out there. I think most of what you said actually applies for a lot of the generations. You know, even if you're 60 years of age, maybe you're creating a life insurance legacy plan, or you're using it to fund long-term care or something along those lines. So that's crucial. Now, Jeff, last thing is, if you thought of taxes, you thought of wealth management, if there was one thing that you want the audience to hear, what do you think that should be?
Well, I think, again, it's that you have the ability to take control and tame this tax tiger. Don't assume that you can kick the can down the road, and don't be complacent and accept the default plan. Be proactive. Go out there and find somebody you trust, make a relationship with them, and then do what they tell you to do, and create your own proactive tax plan with proactive tax management. Opt out of that default plan and control for yourself when and how that money is taxed.
Amen, brother. Appreciate you as always. Thanks for being a part of this podcast, and I'm sure we'll see you on another one here in the future.
Thank you for listening to the Holistic Wealth and Health Podcast. We hope we inspired you to make changes so you can live your best life. If you want to find out more about what we do, or if you want to have a holistic wealth and health financial plan, please call 456-833-7000. Please subscribe to the podcast and share it widely with your friends and family. Financial planning and advisory services are offered through Prosperity Capital Advisors, PCA, an SEC-registered investment advisor with its principal place of business in the state of Ohio. J.L. Smith Holistic Wealth Management and PCA are separate, non-affiliated entities. PCA does not provide tax or legal advice. Insurance and tax services offered through J.L. Smith Holistic Wealth Management are not affiliated with PCA. Information received from this podcast should not be viewed as individual investment advice. Product discussions and illustrations are hypothetical in nature and will vary based on many factors, including, but not limited to, age, health, product, insurance carrier, and product design. You should consult the insurance carrier website and policy for detailed information. For information pertaining to the registration status of PCA, please contact the firm or refer to the investment advisor public disclosure website, www.advisorinfo.sec.gov. For additional information about PCA, including fees and services, send for our disclosure statement as set forth on Form ADV from PCA using the contact information herein. Please read the disclosure statement carefully before you invest or send money.